Question 1. A homeowner's insurance policy in Ohio contains an endorsement that specifies that personal property is covered at its replacement cost rather than actual cash value. If the insured suffers a loss to their 5-year-old television, how will the claim be settled? A. The insured will receive the actual cash value of the television less depreciation. B. The insured will receive the full replacement cost of a new television of like kind and quality. C. The insured will receive a prorated amount based on the age and condition of the television. D. The insured will be reimbursed the amount they originally paid for the television. Correct answer. B. The insured will receive the full replacement cost of a new television of like kind and quality. Explanation. In Ohio, as in many other states, replacement cost coverage means that the insurer pays the cost of replacing the damaged item with a new one of similar kind and quality without considering depreciation. Unlike actual cash value, ACV, which deducts depreciation from the reimbursement, replacement cost coverage ensures that the policyholder can replace the item at today's prices. This concept aligns with the principle of indemnity, ensuring the insured is made whole after a loss. The endorsement modifies the standard settlement provision in the policy, emphasizing that claims for covered losses will be settled based on the current cost to replace the item, not its depreciated value. Question 2. During a severe storm in Ohio, David's home suffers extensive damage due to flooding. He files a claim with his homeowner's insurance policy, which does not have a flood insurance endorsement. How will his claim likely be handled? A. The claim will be fully covered under his standard homeowner's policy. B. The insurer will pay for the damages minus the deductible. C. The claim will be denied because standard homeowner's policies exclude flood damage. D. The claim will be covered only if David can prove negligence on the part of the insurer. Correct answer. C. The claim will be denied because standard homeowner's policies exclude flood damage. Explanation. In Ohio, as in other states, standard homeowners insurance policies exclude flood damage. To cover such damage, a separate flood insurance policy must be obtained, often through the National Flood Insurance Program, NFIP. This exclusion is due to the high-risk nature and potential for catastrophic loss associated with floods, which insurers cannot adequately cover within standard policies without significantly increasing premiums. The insurer, therefore, has no obligation to pay for flood-related damages if the policyholder has not purchased an additional flood insurance policy or endorsement. Question 3. Scenario question. Sarah, an insurance agent in Ohio, discovers that a client failed to disclose a previous fire damage incident during the application for a homeowner's policy. The client later files a claim for an unrelated loss. How should the insurer respond under Ohio law? Assuming this non-disclosure was discovered before the current claim was paid, the insurer must still pay the claim since it is unrelated to the previous incident. B. The insurer can rescind the policy entirely due to material misrepresentation. C. The insurer can apply a penalty and pay only part of the claim. D. The insurer must pay the claim but can increase the premiums retroactively. Correct answer. B. The insurer can rescind the policy entirely due to material misrepresentation. Explanation. Under Ohio law, material misrepresentation can lead to the rescission of an insurance policy. A misrepresentation is considered material if it would have influenced the insurer's decision to issue the policy or set the terms of coverage. In this case, failing to disclose a prior fire damage incident is significant, as it impacts the risk profile of the applicant. The principle of utmost good faith applies, requiring policyholders to provide accurate and complete disclosure. If the insurer discovers a material misrepresentation before any claim is paid, they may legally rescind the policy, voiding the contract from its inception and denying all claims, even those unrelated to the misrepresentation. Question 4. In Ohio, an insurance policy has a coinsurance clause requiring the insured to maintain coverage equal to 80% of the property's replacement cost. If the replacement cost of a building is $500,000 and the insured only carries $300,000 in coverage, how much would the insurer pay for a $200,000 covered loss, assuming no deductible? A. $200,000. B. $150,000. C. $120,000. D. $100,000. Correct answer. B. $150,000. Explanation. The coinsurance clause requires the insured to carry coverage equal to a specified percentage of the property's replacement cost to receive full payment for partial losses. In this case, the required coverage amount is 80% of $500,000, which equals $400,000. Since the insured only carries $300,000, which is 75% of the required $400,000, the insurer will apply a penalty by only covering 75% of the loss amount. Therefore, for the $200,000 loss, the insurer will pay $200,000.75 $150,000. This clause ensures that policyholders do not underinsure their properties and helps the insurer manage risk. Question 5. An Ohio property insurance policy includes an exclusion for earth movement, which states that any damage directly or indirectly caused by an earth movement is not covered. If an earthquake causes a gas pipe to rupture and results in a fire that damages the insured's home, how will the insurer likely respond to a claim for fire damage? The claim will be denied entirely due to the earth movement exclusion. B. The insurer will pay for the fire damage as it is, a separate peril from the earth movement. C. The claim will be partially covered with a deduction for earth movement damage. D. The claim will be denied unless the insured has a special earthquake endorsement. Correct answer. B. The insurer will pay for the fire damage as it is a separate peril from the earth movement. Explanation. Ohio insurance policies generally adhere to the principle of proximate cause, meaning that the insurer must evaluate whether the final, direct cause of loss is a covered peril. In this case, while the earthquake triggered the gas leak, the fire itself is a separate and covered peril under most standard homeowners policies. Thus, even though the earthquake is excluded, the fire damage resulting from it may still be covered, provided the policy does not include a specific exclusion for fire following an earth movement. The distinction between excluded and covered perils is crucial for understanding claims payment under Ohio policies. Question 6. Ohio law requires specific disclosures from insurance agents when providing homeowners insurance quotes. If an agent fails to disclose that the policy has a mandatory deductible for windstorm and hail damage, what potential consequences might arise if the insured files a claim for such a loss? A. The insurer is still obligated to pay the full claim without applying the deductible. B. The agent's error could lead to the insurer waiving the deductible in this instance. C. The insurer may apply the deductible, but the agent could face penalties or disciplinary actions. D. The policy will be considered void, and the insurer will deny the claim entirely. Correct answer. C. The insurer may apply the deductible, but the agent could face penalties or disciplinary actions. Explanation. In Ohio, insurance agents are required to disclose all policy terms, including deductibles for specific perils like windstorm or hail. While the insurer is still within its rights to apply the deductible as stated in the policy, the agent's failure to disclose this information could be seen as an act of negligence or misrepresentation. This may lead to disciplinary actions against the agent by the Ohio Department of Insurance, which could include fines, suspension, or revocation of the agent's license. Proper disclosure is part of the agent's fiduciary duty to clients, helping them make informed choices about their coverage. Question 7. Scenario question. Michael, a business owner in Ohio, has a commercial property insurance policy with a business interruption coverage endorsement. Following a fire that requires his business to close for repairs, Michael files a claim for lost income. However, an insurance adjuster informs him that his claim may be limited due to a 72-hour waiting period in the policy. What does this waiting period mean for Michael's claim? A. Michael's claim will be denied entirely since the 72-hour waiting period was not met. B. Michael will receive coverage only for the last 72 hours of lost income. C. Michael will not receive compensation for the first 72 hours of lost income. D. Michael's claim will be reduced by a set percentage due to the waiting period. Correct answer. C. Michael will not receive compensation for the first 72 hours of lost income. Explanation. Business interruption coverage often includes a waiting period, which is a specified time frame after a loss during which no coverage is provided. In Ohio, if a policy includes a 72-hour waiting period, the insured is responsible for the lost income incurred during that initial period. This waiting period is similar to a deductible in that it requires the insured to bear a portion of the loss before coverage begins. After 72 hours, Michael's business interruption coverage would kick in to compensate him for ongoing lost income while his business is closed for repairs. Question 8. Under Ohio's cancellation and non-renewal laws, an insurer may only cancel a homeowner's policy under specific conditions after the policy has been in effect for more than 90 days. Which of the following would be an acceptable reason for cancellation after this period? A. The insured filed a claim for windstorm damage. B. The insured failed to pay their premium. C. The insured inquired about adding an endorsement. D. The insured requested an explanation of their coverage terms. Correct answer. B. The insured failed to pay their premium. Explanation. According to Ohio law, once a homeowner's insurance policy has been in effect for 90 days, an insurer can only cancel it for specific reasons, including non-payment of premium, material misrepresentation, fraud, or if there's a substantial change in the risk that was not disclosed in the original application. Non-payment of premium is a common, legitimate ground for cancellation after the 90-day period. Simply inquiring about policy details or filing a claim does not constitute valid reasons for cancellation. Question 9. An Ohio personal auto insurance policy includes uninsured motorist coverage. If an insured motorist is injured in an accident caused by a driver who fled the scene, how will the coverage respond? A. It will only cover damages if the fleeing driver is identified. B. It will cover the insured's injuries, as hit-and-run incidents are generally covered under C. It will not cover the incident, as coverage does not apply to hit-and-run cases. D. It will cover property damage, but not bodily injuries. Correct answer. B. It will cover the insured's injuries, as hit-and-run incidents are generally covered under Explanation. In Ohio, uninsured motorist coverage typically extends to hit-and-run accidents, provided the insured can demonstrate that the injuries were caused by another vehicle. This coverage is designed to protect policyholders when the at-fault driver is either uninsured or unidentified, such as in hit-and-run situations. Coverage does not require the fleeing driver to be identified to pay out for injuries resulting from the accident, as the insured's policy treats the unidentified driver as an uninsured motorist. Question 10. Under Ohio insurance regulations, an insurer is required to notify a policyholder of their intent to non-renew a property insurance policy. What is the minimum advance notice period the insurer must provide? A. 10 days. B. 30 days. C. 45 days. D. 60 days. Correct answer. C. 45 days. Explanation. Ohio law mandates that insurers must provide at least 45 days advance notice before the expiration date if they intend not to renew a property insurance policy. This notice period allows policyholders sufficient time to seek alternative coverage if they choose to do so. The 45-day requirement is designed to protect consumers and ensure that they are not left uninsured due to a sudden non-renewal. This rule applies to various property policies, including homeowners and commercial property insurance. Question 11. If an Ohio homeowner's policy includes a loss of use coverage, what type of expenses would this coverage primarily compensate if the insured's home is uninhabitable due to covered peril? A. The cost to repair or rebuild the home. B. The additional living expenses like hotel bills while the home is being repaired. C. Legal fees associated with filing a claim. D. Replacement of personal property lost during the incident. Correct answer. B. The additional living expenses like hotel bills while the home is being repaired. Explanation. Loss of use coverage in Ohio homeowner policies typically covers additional living expenses incurred when an insured's home becomes uninhabitable due to covered peril. This may include expenses like temporary housing, meal costs, and other necessary expenses that exceed the insured's normal living costs. It does not cover repairs to the home itself or replacement of personal property, which are handled under separate coverages within the homeowner's policy. Question 12. In Ohio, if an insured under a personal auto policy has a $500 deductible on collision coverage and a $250 deductible on comprehensive coverage, which deductible applies if their windshield is damaged by a rock while driving? A. The $500 collision deductible. B. The $250 comprehensive deductible. C. Both deductibles apply together. D. No deductible applies to windshield damage in Ohio. Correct answer. B. The $250 comprehensive deductible. Explanation. Damage caused by a rock striking the windshield while driving is generally considered a comprehensive claim, not a collision claim, in Ohio auto insurance policies. Thus, the $250 comprehensive deductible applies. Ohio does not mandate full windshield coverage, so the comprehensive deductible would still be applicable unless the policy includes specific coverage that waives the deductible for glass repairs. Question 13. An Ohio homeowner's insurance policy has a replacement cost endorsement for personal property. If the insured's 5-year-old television, originally purchased for $800, is destroyed in a fire, how would the claim be handled under the replacement cost coverage? A. The insurer would pay $800, the original purchase price. B. The insurer would pay the current cost of a comparable new television. C. The insurer would pay the actual cash value based on the depreciated value of the television. D. The insurer would deny the claim as televisions are not covered. Correct answer. B. The insurer would pay the current cost of a comparable new television. Explanation. Under Ohio policies with a replacement cost endorsement for personal property, the insurer agrees to pay the amount required to replace the lost item with a new, comparable item without deducting for depreciation. This means the insured would receive an amount sufficient to buy a new television of a similar make and model, regardless of the item's age. Replacement cost coverage offers a higher payout than actual cash value, which would have subtracted depreciation. Question 14. Ohio mandates that certain provisions must be included in all automobile insurance policies. Which of the following is one of these mandatory provisions? A. Coverage for flood damage to the vehicle. B. Uninsured underinsured motorist UMUM coverage unless specifically rejected by the insured. C. Coverage for mechanical breakdowns. D. Coverage for theft of personal items inside the vehicle. Correct answer. B. Uninsured underinsured motorist UMUM coverage unless specifically rejected by the insured. Explanation. Ohio law requires insurers to offer uninsured underinsured motorist UMUM coverage in all auto policies, but insureds have the option to reject this coverage in writing. UMUM coverage protects insured drivers if they are injured by a motorist who either has no insurance or insufficient insurance. Flood damage, theft of personal items, and mechanical breakdowns are not mandatory coverages under Ohio auto policies. Question 15. An Ohio resident is looking to purchase homeowners insurance. Which of the following factors is an insurance company legally permitted to consider when determining the policy premium? A. The applicant's race or ethnicity. B. The location of the home and associated crime rate. C. The applicant's credit score, if unrelated to payment history. D. The applicant's marital status. Correct answer. B. The location of the home and associated crime rate. Explanation. In Ohio, insurance companies are permitted to consider the location of the insured property, as it directly relates to the risk of loss due to factors like local crime rates and natural hazards. However, they cannot legally use factors such as race or ethnicity when determining premiums. Marital status may be used in auto insurance but generally not in homeowners, and credit scores are regulated and can only be used in specific ways with consumer protection requirements. Question 16. Ohio homeowners insurance policies typically exclude coverage for flood damage. If an Ohio homeowner wants coverage for flood losses, what action should they take? A. Purchase an endorsement that adds flood coverage to their existing policy. B. Apply for a separate flood insurance policy through the National Flood Insurance Program, NFIP, or a private insurer. C. Add a deductible to their homeowner's insurance policy for flood damage. D. Request flood coverage as part of the standard policy renewal process. Correct answer. B. Apply for a separate flood insurance policy through the National Flood Insurance Program, NFIP, or a private insurer. Explanation. In Ohio, flood damage is generally excluded from standard homeowners insurance policies. Homeowners can obtain flood coverage by purchasing a separate flood insurance policy, typically through the NFIP or a private flood insurance provider. Flood insurance is designed specifically for flood-related risks, and it is not typically available as an endorsement on a standard homeowner's policy. Flood coverage is necessary in flood-prone areas and often required by mortgage lenders. Question 17. In Ohio, if a homeowner's policy has a mortgage clause, What does this clause typically provide? A, protection to the homeowner if they cannot make mortgage payments. B, coverage to the lender even if the policyholder's claim is denied due to policyholder negligence. C, additional liability coverage for incidents occurring on the property. D, higher coverage limits for the insured property. Correct answer. B, coverage to the lender even if the policyholder's claim is denied due to policyholder negligence. Explanation. The mortgage clause in an Ohio homeowner's policy protects the mortgage lender's financial interest in the insured property. This clause states that the insurer will still compensate the lender if the insured fails to comply with policy conditions, such as due care in protecting the property. It ensures the lender is compensated if there's a covered loss, even if the homeowner's actions might otherwise void the coverage. This protection is essential for lenders as it secures their investment. Question 18. A homeowner in Ohio experiences a fire in their detached garage, causing significant damage to the structure and its contents. Under a typical Ohio homeowner's insurance policy, what type of coverage would apply to this structure? A, dwelling coverage. B, personal property coverage. C, other structures coverage. D, loss of use coverage. Correct answer. C, other structures coverage. Explanation. Ohio homeowners insurance policies typically include other structures coverage, which applies to buildings on the insured property that are not attached to the main dwelling, such as detached garages, sheds, or fences. This coverage is separate from the dwelling and personal property coverage, each of which has specific allocations and limits. Other structures coverage is usually set at a percentage of the dwelling coverage amount, commonly around 10%, though additional coverage may be purchased if needed. Question 19. Which of the following is true about personal umbrella insurance policies available to Ohio residents? A. Umbrella policies only cover losses that are also covered under the primary policy. B. Umbrella policies provide additional liability coverage beyond standard limits of primary policies. C. Umbrella policies can be added to homeowner policies to cover damage to personal property. D. Umbrella policies provide replacement cost coverage for all property losses. Correct answer. B. Umbrella policies provide additional liability coverage beyond standard limits of primary policies. Explanation. Umbrella insurance policies are designed to provide extra liability protection above the limits of primary insurance policies, such as homeowners or auto insurance, and can also offer coverage for some liability situations not covered by primary policies. They do not cover personal property or provide replacement cost for property. Rather, they extend liability limits to protect against large claims or lawsuits, offering peace of mind and financial protection in case of significant liability claims. Question 20. In Ohio, which type of water damage is typically covered under a standard homeowner's insurance policy? A. Damage from flooding due to a natural disaster. B. Gradual damage from a long-term leak. C. Damage from a burst pipe that occurs suddenly and unexpectedly. D. Mold damage resulting from long-term humidity issues. Correct answer. C. Damage from a burst pipe that occurs suddenly and unexpectedly. Explanation. Standard homeowners insurance policies in Ohio typically cover sudden and accidental water damage such as from a burst pipe. However, they generally do not cover damage from gradual leaks, flooding, or mold resulting from ongoing issues. Flooding requires separate flood insurance, and maintenance issues like gradual leaks or mold are considered the homeowner's responsibility. Coverage is intended to protect against unforeseen events, not damage that could have been prevented through regular maintenance. Question 21. Which of the following is typically covered under the liability section of a standard homeowner's insurance policy? A. Fire damage to the insured's home. B. Theft of the insured's personal property. C. Medical expenses for a guest injured on the insured's property. D. Flood damage to the basement. Correct answer. C. Medical expenses for a guest injured on the insured's property. Explanation. The liability section of a homeowner's policy covers claims for bodily injury or property damage for which the insured is legally responsible, including medical expenses for guests injured on the property. Fire damage and theft and B are covered under property sections, while flood damage D usually requires separate coverage. Question 22. What type of policy would a business owner purchase to cover losses from a cyber attack that leads to a data breach? A. Commercial property insurance. B. General liability insurance. C. Cyber liability insurance. D. Business interruption insurance. Correct answer. C. Cyber liability insurance. Explanation. Cyber liability insurance provides coverage for incidents related to cyber attacks such as data breaches, ransomware, and network security failures. Other policies, D, do not specifically address cyber-related risks. Question 23. Which type of insurance coverage is specifically designed to cover legal fees and settlements when a professional is sued for negligence in their work? A. General liability insurance. B. Professional liability insurance. C. Directors and officers, DO, insurance. D. Workers' compensation insurance. Correct answer. B. Professional liability insurance. Explanation. Professional liability insurance, also known as errors and omissions, EO, insurance, protects professionals against claims of negligence or inadequate work. General liability, A, covers physical injuries and property damage, while DO insurance, C, covers company leadership and workers' compensation. D, pertains to employee injuries. Question 24. Which term best describes the portion of an insurance policy that states the insured's obligations in the event of a loss? The insuring agreement. B. Conditions. C. Exclusions. D. Declarations. Correct answer. B. Conditions. Explanation. The conditions section of an insurance policy outlines the responsibilities and obligations of both the insurer and the insured. This includes what actions must be taken when a loss occurs, such as reporting and providing proof of loss. Question 25. Which of the following is not a function of an insurance underwriter? A. Assessing the risk of insuring an applicant. B. Determining the terms of a policy. C. Selling insurance policies directly to customers. D. Setting premium rates based on risk. Correct answer. C. Selling insurance policies directly to customers. Explanation. Insurance underwriters evaluate risks, determine policy terms, and set premiums. Selling insurance policies is typically done by agents or brokers, not underwriters. Question 26. What type of auto insurance coverage is necessary for damage to the policyholder's own vehicle in a collision they caused? A. Liability coverage. B. Comprehensive coverage. C. Collision coverage. D. Uninsured motorist coverage. Correct answer. C. Collision coverage. Explanation. Collision coverage pays for the repair or replacement of the policyholder's vehicle when they are at fault in an accident. Liability coverage, A, covers damage to others, while comprehensive, B, covers non-collision incidents, and uninsured motorist, D, applies when the other driver lacks insurance. Question 27. What type of policy should an individual purchase if they want protection that will pay out benefits upon their death? A, disability insurance. B, health insurance. C, term life insurance. D, long-term care insurance. Correct answer. C, term life insurance. Explanation. Term life insurance provides death benefits to beneficiaries if the insured passes away during the term of the policy. Disability insurance, A, covers lost income due to inability to work. Health insurance, B, pays for medical expenses. And long-term care insurance, D, covers extended care services. Question 28. Which insurance concept refers to the transfer of risk from an individual to an insurer in exchange for premium payments? A, indemnity. B, reinsurance. C, risk management. D, risk pooling. Correct answer. A, indemnity. Explanation. Indemnity refers to the concept of compensating for a loss, effectively transferring risk from an individual to an insurer who accepts it in return for premiums. Reinsurance, B, involves risk transfer between insurers, and risk pooling, D, spreads risk among a group. Question 29. What is the purpose of an insurable interest in an insurance contract? A. To determine the insurance policy's deductible. B. To ensure that policyholder can receive coverage for any risk. C. To prevent policyholders from profiting from insurance fraud. D. To set the maximum claim amount. Correct answer. C. To prevent policyholders from profiting from insurance fraud. Explanation. Insurable interest means that the policyholder must have a legitimate interest in the insured item or person, preventing them from obtaining insurance to profit from a loss. It ensures a genuine economic stake exists in the preservation of the insured property or person. Question 30. Which type of homeowner's policy is specifically designed for renters? A. HA2, B. HA3, C. HA4, D. HA5. Correct answer. C. HA4. Explanation. The HA4 policy, known as a renter's policy, provides coverage for personal property and liability for individuals who rent their homes. Other policies, HA2, HA3, HA5, are tailored for homeowners. Question 31. Under a homeowner's insurance policy, which of the following best describes the primary purpose of an additional living expense provision? A. To cover the costs of repairing the insured's property after a loss. B. To reimburse the insured for lost rental income. C. To cover increased expenses for temporary housing if the home is uninhabitable due to a covered loss. D. To pay for routine maintenance costs of the insured property. Correct answer. C. To cover increased expenses for temporary housing if the home is uninhabitable due to a covered loss. Explanation. The additional living expense L provision in a homeowner's insurance policy is designed to help the policyholder maintain their standard of living if their home is rendered uninhabitable by a covered peril, such as fire or storm damage. This coverage reimburses costs for temporary housing, meals, and other increased expenses until repairs are complete. It does not cover repairs to the property, lost rental income, or regular maintenance costs, which are addressed in different parts of the policy or are excluded. Question 32. What is the purpose of subrogation in a property insurance policy? A. To allow the insurer to recover funds from a third party responsible for a loss. B. To waive the deductible for the insured. C. To extend coverage to multiple properties owned by the insured. D. To provide a discount on premium for policyholders who have no claims. Correct answer. A. To allow the insurer to recover funds from a third party responsible for a loss. Explanation. Subrogation gives the insurer the right to pursue a third party that caused a loss to the insured. After the insurer pays the insured for the loss, it can step into the shoes of the insured to seek compensation from a liable party. This process helps insurers control costs and premiums. Deductibles, multiple property coverage, and claim-free discounts are not related to subrogation. Question 33. An insured has a replacement cost policy on their property, but they are only compensated for the actual cash value, CV, after a loss. Under what condition would they later receive the full replacement cost? They agree to settle the claim immediately without further adjustments. B. They complete the necessary repairs or replacement of the damaged property. C. The damage is caused by a natural disaster. D. They have been insured with the same company for over 5 years. Correct answer. B. They complete the necessary repairs or replacement of the damaged property. Explanation. In a replacement cost policy, initial payments may be limited to the actual cash value, ACV, until the insured provides evidence of repairs or replacement. Once these are completed, the insurer typically pays the difference up to the full replacement cost. The policyholder's tenure with the company or cause of damage does not typically impact this condition, and settling without adjustments would forfeit the chance for additional compensation. Question 34. Which of the following is an example of loss of use coverage in a property insurance policy? Q. Reimbursement for temporary housing costs if the insured's home is uninhabitable. B. Replacement of personal property damaged by fire. C. Payment for legal expenses if the insured is sued. D. Coverage for landscaping destroyed by a covered peril. Correct answer. A. Reimbursement for temporary housing costs if the insured's home is uninhabitable. Explanation. Loss of use coverage, also known as additional living expenses, is designed to help with temporary living costs if the insured's residence becomes uninhabitable due to A covered loss, this coverage is separate from property replacement, legal liability, or landscaping coverage, which are handled by other sections of a policy. Question 35. Which of the following best describes the concept of coinsurance in property insurance? A. A policy provision requiring the insured to pay a percentage of each claim. B. An arrangement where multiple insurers cover the same property. C. A requirement that the insured maintain insurance equal to a specified percentage of the property's value. D. An additional premium charged for high-value items. Correct answer. C. A requirement that the insured maintain insurance equal to a specified percentage of the property's value. Explanation. Coinsurance is a policy condition requiring the insured to carry insurance equal to a specific percentage, often 80% or 90% of the property's value. If the insured fails to meet this requirement, they may be penalized by receiving a reduced claim payout. This concept does not involve per claim cost sharing, multiple insurers, or high-value item premiums. Question 36. In a commercial property policy, what is typically covered under business interruption insurance? A. Physical damage to the insured's building. B. Lost profits and ongoing expenses while the business is closed due to a covered peril. C. Costs of replacing damaged machinery. D. Payment for employee injury claims. Correct answer. B. Lost profits and ongoing expenses while the business is closed due to covered peril. Explanation. Business interruption insurance provides financial protection for a business's lost income and ongoing expenses if it cannot operate due to a covered event like a fire. Physical damage, machinery replacement, and employee injury claims are addressed separately, usually under property, equipment, and workers' compensation coverage. Question 37. An insured person accidentally causes a kitchen fire while cooking, leading to extensive smoke and fire damage throughout the home. Which part of a homeowner's insurance policy would most likely pay for the repair costs? A. Personal liability coverage. B. Medical payments to others. C. Dwelling coverage. D. Loss of use coverage. Correct answer. C. Dwelling coverage. Explanation. Dwelling coverage in a homeowner's policy is designed to cover physical damage to the insured structure, including fire and smoke damage. Personal liability coverage is for injuries or property damage to others. Medical payments cover injuries to guests, and loss of use covers additional living expenses if the home is uninhabitable. Question 38. Which of the following describes a key difference between an open peril policy and a named peril policy? A. An open peril policy covers only specified risks, while a named peril policy covers all risks except those excluded. B. A named peril policy covers only specified risks, while an open peril policy covers all risks except those specifically excluded. C. Both policies cover all risks but differ in their exclusions. D. A named peril policy is for homeowners, while an open peril policy is for renters. Correct answer. B. A named peril policy covers only specified risks, while an open peril policy covers all risks except those specifically excluded. Explanation. Named peril policies limit coverage to explicitly listed perils, e.g., fire, theft, whereas open peril policies provide broader protection, covering any risk except those listed as exclusions. These policies apply to both homeowners and renters, contrary to answer option D. Question 39. Which of the following is true about replacement cost coverage compared to actual cash value received coverage? The replacement cost pays the depreciated value, while ACV pays for the full replacement without depreciation. B. Replacement cost pays the full cost to replace the item without depreciation, while ACV deducts depreciation. C. Both replacement cost and ACV are calculated based on the market value of the item. D. ACV typically has a higher premium than replacement cost coverage. Correct answer. B. Replacement cost pays the full cost to replace the item without depreciation, while ACV deducts depreciation. Explanation. Replacement cost coverage reimburses the insured for the full cost to replace damaged property with a similar item without considering depreciation. Actual cash value, ACV, coverage, however, takes depreciation into account, meaning the insured receives a lesser amount based on the item's age or condition. Question 40. If a policyholder fails to disclose a known hazard when applying for property insurance, what could be the insurer's response upon discovering this omission after a loss occurs? The insurer must still pay the claim regardless of the omission. B. The insurer may rescind the policy if the omission is considered material. C. The insurer can deny the claim but cannot cancel the policy. D. The insurer is required to adjust the premium to reflect the undisclosed risk. Correct answer. B. The insurer may rescind the policy if the omission is considered material. Explanation. In property insurance, a material omission, such as failing to disclose a significant hazard, can give the insurer grounds to rescind, void, the policy if it influenced the underwriting decision. Non-material omissions may not affect coverage, and premium adjustments typically do not apply retroactively in such cases. Question 41. In Ohio, which of the following is considered an unfair claims practice by an insurance company? A. Paying a claim within 30 days of receipt. B. Failing to promptly investigate a claim. C. Conducting thorough background checks on claimants. D. Offering settlement options to the claimant. Correct answer. B. Failing to promptly investigate a claim. Explanation. Ohio law considers it an unfair claims practice if an insurer does not promptly investigate a claim. According to the Ohio Administrative Code, OC 3901154, insurers are required to act with efficiency and in good faith when handling claims. Delays in investigation and settlement, if unreasonable, are seen as a violation of fair claims practices, which protects the insured's right to timely claim resolution. Question 42. Under Ohio insurance law, an insurance agent's license may be suspended or revoked for which of the following actions? A. Refusing to renew their license. B. Failing to complete a client's application. C. Misrepresenting policy terms to client. D. Declining to represent a specific insurance company. Correct answer. C. Misrepresenting policy terms to client. Explanation. Ohio Revised Code, ORC 3905.14 allows the state to suspend, revoke, or refuse to renew an insurance agent's license if the agent is found to have misrepresented the terms of a policy. Misrepresentation is a violation of ethical standards and may mislead clients about the nature or extent of coverage. Question 43. Which of the following is required in Ohio for an insurer to legally deny a claim? A. Evidence that the insured committed fraud. B. An initial payment offered to the insured. C. Proof that the insured had prior losses. D. A report from the insurance commissioner. Correct answer. A. Evidence that the insured committed fraud. Explanation. In Ohio, insurers can deny a claim if there is clear evidence of fraud. According to ORC 2913.47, insurance fraud includes any act in which a person knowingly presents false information to an insurer with the intent to deceive or mislead. If fraud is detected, insurers can lawfully deny the claim to protect against improper payments. Question 44. In Ohio, how long does an insured have to file a claim under a standard homeowner's insurance policy? A. 30 days after the loss. B. 90 days after the loss. C. 1 year after the loss. D. 2 years after the loss. Correct answer. C. 1 year after the loss. Explanation. Standard homeowners insurance policies in Ohio typically have a statute of limitations of 1 year for filing claims. The suit against us provision within most homeowners policies sets this 1 year limit, which is also consistent with Ohio's insurance contract statutes. Question 45. Which of the following types of losses is covered by Ohio's mine subsidence insurance? A. Damage due to an earthquake. B. Damage caused by flooding. C. Structural damage from ground shifting due to coal mining. D. Damage from falling objects. Correct answer. C. Structural damage from ground shifting due to coal mining. Explanation. Mine subsidence insurance in Ohio provides coverage for property damage due to subsidence, which is ground movement caused by past coal mining activities. This coverage is managed under the Ohio Mine Subsidence Insurance Fund and is designed to protect homes in regions where mining activities increase the risk of ground instability. Question 46. In Ohio, the State Guarantee Association provides protection to policyholders in the event of an insurance company insolvency. Which type of policy is generally not covered by this guarantee? A. Life insurance policies. B. Property insurance policies. C. Annuity contracts. D. Surplus lines insurance. Correct answer. D. Surplus lines insurance. Explanation. The Ohio Insurance Guarantee Association, OIGA, does not cover surplus lines insurance, as these policies are written by non-admitted insurers. Surplus lines insurers operate outside the Ohio Guarantee Fund's protection, meaning policyholders should be aware of the additional risk of insolvency without state-backed financial security. Question 47. What is the minimum liability coverage required by Ohio law for bodily injury per accident in an auto insurance policy? A. $12,500 per accident. B. $25,000 per accident. C. $50,000 per accident. D. $100,000 per accident. Correct answer. B. $25,000 per accident. Explanation. Ohio's minimum financial responsibility law requires a minimum of $25,000 in liability coverage for bodily injury or death per accident. This minimum helps ensure that Ohio drivers have basic protection for third parties in the event of an at-fault accident. Question 48. In Ohio, if an insurance policy is canceled due to non-payment, what is the minimum advance notice an insurer must provide to the policyholder? A. 5 days. B. 10 days. C. 15 days. D. 30 days. Correct answer. B. 10 days. Explanation. Ohio insurance law mandates that insurers provide a minimum of 10 days notice before canceling a policy for non-payment of premium. This regulation, found in ORC 3937.25, allows policyholders a reasonable time to rectify payment issues to avoid coverage lapses. Question 49. According to Ohio law, a personal auto policy's uninsured motorist coverage applies in which of the following situations? A. The insured vehicle is damaged by a hit-and-run driver. B. The insured causes an accident with another driver. C. The insured is involved in an accident outside Ohio. D. The insured's vehicle is vandalized. Correct answer. A. The insured vehicle is damaged by a hit-and-run driver. Explanation. Ohio's uninsured motorist coverage protects insureds when involved in accidents with drivers who are uninsured or unidentified, such as in a hit-and-run. The coverage addresses bodily injuries caused by hit-and-run incidents, which are treated similarly to incidents with uninsured motorists under Ohio insurance laws. Question 50. In Ohio, if a property insurance claim is denied by the insurer, how can the insured dispute this denial? A. By requesting a policy cancellation. B. By filing a complaint with the Ohio Department of Insurance. C. By purchasing additional coverage. D. By paying an additional premium to reopen the claim. Correct answer. B. By filing a complaint with the Ohio Department of Insurance. Explanation. If a claim is denied, Ohio policyholders can file a complaint with the Ohio Department of Insurance, OD, to investigate potential unfair treatment. The ODI evaluates whether the insurer's denial violates Ohio's unfair claims practices, regulations, or other state insurance laws. Question 51. Under Ohio law, which of the following would likely make a homeowner ineligible for standard homeowners insurance? A. The home is vacant. B. The home is older than 50 years. C. The homeowner has a pet dog. D. The home has a swimming pool. Correct answer. A. The home is vacant. Explanation. A vacant home generally poses higher risks such as vandalism or unreported damage, making it more challenging to insure under a standard homeowner's policy in Ohio. Insurers often require specialized vacant property insurance to cover homes that are unoccupied for extended periods. Question 52. In Ohio, how often must an insurance agent complete continuing education to maintain their license? A. Every year. B. Every 2 years. C. Every 3 years. D. Every 5 years. Correct answer. B. Every 2 years. Explanation. Ohio law requires licensed insurance agents to complete continuing education every 2 years to ensure they stay updated on industry regulations and practices. This includes completing 24 hours of approved courses, including ethics, as mandated by the Ohio Department of Insurance. Question 53. Which of the following types of insurance policies would NOT typically be eligible for coverage under the Ohio FAIR Fair Access to Insurance Requirements Plan? A. Standard homeowners insurance. B. High-risk property insurance. C. Auto insurance. D. Basic fire insurance. Correct answer. C. Auto insurance. Explanation. The Ohio FAIR plan is designed to provide property insurance for high-risk properties that may not be eligible for standard coverage. It does not cover auto insurance, which is regulated under a separate framework with its own requirements in Ohio. Question 54. What is the minimum combined liability coverage required by Ohio law for bodily injury and property damage in an auto insurance policy? A. $25,000. B. $50,000. C. $75,000. D. $100,000. Correct answer. B. $50,000. Explanation. Ohio law mandates minimum liability coverage limits of $25,000 per person and $50,000 per accident for bodily injury and $25,000 for property damage. Therefore, the minimum combined liability requirement is $50,000 for bodily injury. Question 55. In Ohio, within how many days must an insurer respond to an insured's inquiry about a claim? A. 10 days. B. 15 days. C. 21 days. D. 30 days. Correct answer. A. 10 days. Explanation. According to the Ohio Administrative Code OC 3901-154, insurers are required to respond to inquiries related to claims within 10 days. This ensures timely communication and transparency for policyholders. Question 56. Ohio law requires auto insurance policies to provide coverage for which of the following? A. Intentional acts of damage by the insured. B. Wear and tear of the vehicle. C. Bodily injury and property damage liability. D. Mechanical breakdowns. Correct answer. C. Bodily injury and property damage liability. Explanation. Ohio requires all drivers to carry liability insurance that covers bodily injury and property damage. This basic requirement ensures that drivers are financially responsible for damages or injuries they may cause to others in an accident. Question 57. Under Ohio law, when must an insurance company provide a cancellation notice for a personal auto policy after it has been in effect for 90 days? A. At least 7 days before cancellation. B. At least 10 days before cancellation. C. At least 15 days before cancellation. D. At least 30 days before cancellation. Correct answer. D. At least 30 days before cancellation. Explanation. Ohio law requires insurers to give at least 30 days notice before canceling a personal auto policy that has been active for more than 90 days, except for reasons related to non-payment, in which case a 10-day notice is required. Question 58. Which of the following is true regarding the Ohio Automobile Insurance Plan? A. It is mandatory for all drivers in Ohio. B. It provides minimum liability coverage to high-risk drivers who cannot find insurance in the open market. C. It guarantees full comprehensive coverage for high-risk drivers. D. It is funded by the Ohio Department of Insurance. Correct answer. B. It provides minimum liability coverage to high-risk drivers who cannot find insurance in the open market. Explanation. The OAIP is designed to ensure that high-risk drivers who cannot obtain auto insurance from standard insurers still have access to minimum liability coverage. Insurers participate in this plan to help reduce the number of uninsured drivers. Question 59. Ohio's financial responsibility law requires proof of insurance in which of the following scenarios? A. When registering a vehicle. B. Only when involved in an accident. C. When selling a vehicle. D. At any time while driving. Correct answer. D. At any time while driving. Explanation. Ohio law mandates that proof of financial responsibility, usually an insurance policy, be available at all times when operating a vehicle. This requirement is to ensure that drivers are financially prepared for any liabilities resulting from accidents. Question 60. Which of the following does Ohio law allow as grounds for an insurance company to cancel a homeowner's insurance policy? A. The homeowner adds a new roof to their property. B. The homeowner installs a pool with a fence. C. Non-payment of premiums. D. The home's exterior color is changed. Correct answer. C. Non-payment of premiums. Explanation. Ohio law allows insurers to cancel a homeowner's insurance policy if the insured fails to pay the premium. Other reasons may include material misrepresentation or a significant increase in risk, but factors like roof improvements or color changes do not qualify. Question 61. Which of the following types of insurance would cover damages to a vehicle caused by hail? A. Liability insurance. B. Collision insurance. C. Comprehensive insurance. D. Uninsured motorist insurance. Correct answer. C. Comprehensive insurance. Explanation. Comprehensive insurance provides coverage for non-collision related damage to a vehicle, including weather-related incidents like hail, as well as theft, vandalism, and fire. Question 62. In a standard homeowner's insurance policy, coverage C typically refers to which type of coverage? A. Personal liability. B. Personal property. C. Dwelling. D. Loss of use. Correct answer. B. Personal property. Explanation. Coverage C. A standard homeowner's insurance policy covers personal property, which includes the insured's belongings within and sometimes outside the home, such as furniture, clothing, and electronics. Question 63. Under a standard auto insurance policy, what does uninsured motorist coverage protect against? A. Damage caused by an at-fault driver without insurance. B. Vehicle damage caused by natural disasters. C. Liability claims made against the insured. D. Injury to passengers in the insured's vehicle. Correct answer. A. Damage caused by an at-fault driver without insurance. Explanation. Uninsured motorist coverage protects the insured if they are injured or their property is damaged in an accident caused by an at-fault driver who lacks insurance. Question 64. Which of the following would typically be excluded under a standard homeowner's insurance policy? A. Fire damage to the home. B. Theft of personal property. C. Water damage from a flood. D. Damage from a fallen tree. Correct answer. C. Water damage from a flood. Explanation. Flood damage is usually excluded from standard homeowners policies and requires separate flood insurance, which can be purchased through programs like the National Flood Insurance Program and FIT. Question 65. In property and casualty insurance, the term subrogation refers to A. An insurer's right to recover costs from a third party responsible for a loss. B. The process of determining the value of an insured item. C. Coverage for additional living expenses. D. A discount for bundling multiple policies. Correct answer. A. An insurer's right to recover costs from a third party responsible for a loss. Explanation. Subrogation allows the insurer to seek reimbursement from a third party that is at fault after the insurer has paid a claim to the policyholder. Question 66. Which of the following best describes the purpose of liability insurance? A. To pay for damages to the insured's own property. B. To provide coverage for injuries or damages caused to third parties. C. To cover medical expenses for the insured's family. D. To replace lost income due to illness. Correct answer. B. To provide coverage for injuries or damages caused to third parties. Explanation. Liability insurance covers legal costs and damages if the insured is held responsible for injuring others or damaging their property, rather than covering personal property or medical expenses for the insured's family. Question 67. Which of the following is an example of a moral hazard in property insurance? A. An insured property is located in a high-crime area. B. A homeowner fails to lock their doors regularly. C. The policyholder intentionally damages their own property. D. A property is at high risk due to its location near a forest. Correct answer. C. The policyholder intentionally damages their own property. Explanation. A moral hazard involves the policyholder's intentional actions or behavior that increases the likelihood of a claim, such as intentionally damaging their own property to collect insurance proceeds. Question 68. What is the main purpose of coinsurance in a property insurance policy? A. To share the risk with another insurance provider. B. To encourage policyholders to insure property to a specific value. C. To allow multiple claims within a policy term. D. To reduce premium costs for policyholders. Correct answer. B. To encourage policyholders to insure property to a specific value. Explanation. Coinsurance requires the policyholder to insure their property for a minimum percentage of its value, typically 80%, to receive full coverage on partial losses. Failing to meet this requirement may result in reduced claim payouts. Question 69. Which type of insurance policy would most likely cover injuries sustained by a customer at a business? A. Workers' compensation insurance. B. Product liability insurance. C. Commercial general liability insurance. D. Property insurance. Correct answer. C. Commercial general liability insurance. Explanation. Commercial general liability insurance protects businesses against claims for bodily injury or property damage caused to third parties on their premises, such as customers or vendors. Question 70. What does a fidelity bond cover in a business insurance context? A. Damage to business-owned vehicles. B. Employee theft or dishonesty. C. General liability claims. D. Equipment breakdown. Correct answer. B. Employee theft or dishonesty. Explanation. A fidelity bond provides coverage to businesses for losses resulting from fraudulent acts or theft committed by employees, offering financial protection against potential employee dishonesty. Question 71. In Ohio, what is the minimum required liability coverage for bodily injury per person in an auto insurance policy? A. $10,000. B. $25,000. C. $50,000. D. $100,000. Correct answer. B. $25,000. Explanation. Ohio law mandates that all drivers carry a minimum of $25,000 in bodily injury liability coverage per person in case of an accident. Question 72. Which of the following is true about uninsured motorist coverage in Ohio? A. It is mandatory for all Ohio drivers. B. It is not required, but insurers must offer it. C. It is only required for high-risk drivers. D. It includes coverage for property damage only. Correct answer. B. It is not required, but insurers must offer it. Explanation. In Ohio, uninsured motorist coverage is not mandatory, but insurers are required to offer it to policyholders who can choose to decline in writing. Question 73. Ohio's Department of Insurance primarily exists to A. Create insurance policies for consumers. B. Regulate and enforce insurance laws and protect consumers. C. Set insurance premium rates across the state. D. Provide insurance to high-risk individuals. Correct answer. B. Regulate and enforce insurance laws and protect consumers. Explanation. The Ohio Department of Insurance is responsible for regulating the state's insurance industry, enforcing laws, and protecting consumers by ensuring fair practices. Question 74. Which of the following best describes the Ohio valued policy law? A. Insurers must pay the market value of a home in all claims. B. Insurers are required to cover flood damage. C. Total loss claims must be settled at the policy limit for property policies. D. Insurers can deny claims for total loss if the insured is at fault. Correct answer. C. Total loss claims must be settled at the policy limit for property policies. Explanation. The Ohio valued policy law requires that if a property is deemed a total loss, The insurance payout must match the policy limit, regardless of the property's current market value. Question 75. Under Ohio law, how long does a life insurance company have to settle a claim after receiving proof of the insured's death? A. 15 days. B. 30 days. C. 60 days. D. 90 days. Correct answer. B. 30 days. Explanation. Ohio law requires that life insurance companies settle claims within 30 days after receiving proof of death to ensure timely benefits for beneficiaries. Question 76. In Ohio, which of the following actions could lead to the suspension or revocation of an insurance agent's license? A. Selling only one type of insurance. B. Accepting commissions from out-of-state policies. C. Failing to complete continuing education requirements. D. Renewing a client's policy without their consent. Correct answer. C. Failing to complete continuing education requirements. Explanation. Ohio law mandates that insurance agents complete continuing education requirements, and failure to do so could result in the suspension or revocation of their license. Question 77. Ohio's financial responsibility law requires drivers to maintain which of the following? A. Minimum liability insurance coverage. B. Collision insurance for finance vehicles. C. Proof of no prior accidents. D. A minimum credit score. Correct answer. A minimum liability insurance coverage. Explanation. Ohio's financial responsibility law mandates that drivers carry liability insurance or equivalent financial responsibility to cover damages in case of an accident. Question 70. In Ohio, which of the following individuals may be eligible for coverage through the Ohio Automobile Insurance Plan? A. High-risk drivers who cannot obtain insurance on the open market. B. Drivers with multiple vehicles. C. Policyholders seeking a lower premium. D. Drivers with an active policy cancellation. Correct answer. A. High-risk drivers who cannot obtain insurance on the open market. Explanation. The Ohio Automobile Insurance Plan provides insurance to high-risk drivers who have been unable to secure coverage through standard insurance providers. Question 79. Ohio law requires insurers to notify policyholders how many days in advance if they intend to cancel a personal auto policy due to non-payment? A. 5 days. B. 10 days. C. 15 days. D. 30 days. Correct answer. B. 10 days. Explanation. Under Ohio law, insurers must provide a minimum of 10 days' notice before canceling an auto insurance policy due to non-payment, giving policyholders time to address their premium. Question 80. What is the primary purpose of Ohio's Guarantee Association? A. To provide auto insurance to low-income residents. B. To ensure claim payments if an insurance company becomes insolvent. C. To regulate premium rates across the state. D. To assist uninsured drivers after an accident. Correct answer. B. To ensure claim payments if an insurance company becomes insolvent. Explanation. Ohio's Guarantee Association protects policyholders by paying claims if an insurer becomes insolvent, offering a financial safety net to Ohio residents. Question 81. What is the minimum liability coverage required per accident for bodily injury in Ohio? A. $15,000. B. $25,000. C. $50,000. D. $75,000. Correct answer. C. $50,000. Explanation. Ohio law requires drivers to have a minimum liability coverage of $50,000 per accident for bodily injury, ensuring coverage for multiple injured parties. Question 82. If an Ohio resident's homeowner's insurance policy is canceled by the insurer, how many days' notice must they receive? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Correct answer. C. 30 days. Explanation. Ohio law mandates a 30-day advance notice for cancellation of homeowners' insurance policies. except for cases involving non-payment where a 10-day notice is required. Question 83. In Ohio, who oversees the licensing and conduct of insurance agents? A. The Ohio Secretary of State. B. The Ohio Insurance Commissioner. C. The Ohio Department of Insurance. D. The Federal Insurance Office. Correct answer. C. The Ohio Department of Insurance. Explanation. The Ohio Department of Insurance is responsible for regulating and licensing insurance agents, ensuring they meet the state's standards and ethical requirements. Question 84. What is required of an Ohio insurance agent to reinstate their license after a suspension? A. Pay a reinstatement fee only. B. Complete additional continuing education credits. C. Reapply for the license from scratch. D. Take a criminal background check. Correct answer. B. Complete additional continuing education credits. Explanation. In Ohio, agents typically need to complete extra continuing education to regain a suspended license, ensuring they are up to date on current laws and regulations. Question 85. Under Ohio law, which of the following types of damages are typically excluded from a standard homeowner's insurance policy? A. Fire damage. B. Water damage from flooding. C. Wind damage. D. Vandalism. Correct answer. B. Water damage from flooding. Explanation. Flood damage is generally excluded from standard homeowners policies in Ohio. Flood coverage is typically available as a separate policy through the National Flood Insurance Program. Question 86. Which of the following is required by Ohio law for a life insurance policy to be reinstated after it lapses? A. Payment of overdue premiums plus interest. B. Reapplication for the policy. C. Proof of no prior claims. D. A new medical examination. Correct answer. A. Payment of overdue premiums plus interest. Explanation. In Ohio, policyholders can reinstate a lapsed life insurance policy by paying overdue premiums plus any accrued interest, provided the lapse period is within policy limits. Question 87. What is the waiting period before an insurer can cancel a health insurance policy in Ohio for reasons other than non-payment? A. 15 days. B. 30 days. C. 45 days. D. 60 days. Correct answer. B. 30 days. Explanation. Ohio requires a 30-day advance notice before an insurer can cancel a health insurance policy, allowing the insured time to seek alternative coverage. Question 88. For insurance policies in Ohio, when must an agent inform the insured about their right to privacy regarding personal information? A. Upon policy renewal. B. At each policy adjustment. C. Before issuing the policy. D. Only if the insured requests it. Correct answer. C. Before issuing the policy. Explanation. Ohio law mandates that agents inform clients of their privacy rights regarding personal information before issuing an insurance policy, promoting transparency. Question 89. How often must Ohio insurance agents renew their licenses? A. Every year. B. Every 2 years. C. Every 3 years. D. Every 5 years. Correct answer. B. Every 2 years. Explanation. Ohio insurance agents are required to renew their licenses every 2 years and must complete continuing education credits to remain compliant with state regulations. Question 90. In Ohio, a business owner seeking coverage for work-related injuries must obtain which type of insurance? A. Disability insurance. B. Workers' compensation insurance. C. Liability insurance. D. Health insurance. Correct answer. B. Workers' compensation insurance. Explanation. Ohio law requires employers to provide workers' compensation insurance to cover work-related injuries or illnesses, ensuring support for employees affected by workplace incidents.